Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to James Helliwell, a professional trader and chief investment strategist at $1,000,000Traders. So welcome, James.
Hi, Paul. Good to be on the channel. Thank you for having me.
Yeah, well, it's been a sort of one-way bet for Robinhood and Reddit traders over the past 12 months. The markets have sort of like largely gone one way. We're sort of culminating in January with the ceremonial flogging of a few hedge funds who went short GameStop. However, the mood music seems to have changed a little with the sort of the yield on the 10-year Treasury tipping up to sort of 1.5%. How do you see the sort of like capital markets going forward, and really from a trading perspective?
It's actually, I think, as you just touched on, it's got increasingly complicated, and I think the return to reality in the past 2 or 3 weeks, certainly, but really the last month, saw the return of the resurgence in tech and momentum. So the traditional areas that you've been talking about, the retail traders would typically focus on or have focused on for the past 12 months post-COVID and the onset of the pandemic. And to be honest, where a lot of institutional managers have been correctly positioned for the past decade, for the most part, the past decade. But, you know, there's a reminder, particularly for those of us who don't regard ourselves as global macro traders. There's a sudden sharp reminder that it's not just a one-way bet being long stocks and momentum names in particular. And certainly the reminder that we've had in the last 2 or 3 weeks, and it's top of my watch list, and I have had to adapt in the last couple of weeks. Yeah, I mean, it's a massive question. Where does it go from here? But the level that the US 10 years at now, I glanced to the other screen. Well, I've got it up, like even now as we're doing this, after Friday's close and it touching back on 1.6 now, it really does look risky. If it breaks any higher, it's at sort of final resistance here, and we could target 2 to 235, I think. So yeah, it's a very interesting time, a lot to digest. Even the Fed, not surprisingly perhaps, but even the Fed has painted themselves or backed themselves into something of the corner. So we've got to see how it plays out. There's a lot to discuss
and presumably that's sort of putting pressure on a lot of the sort of the long duration assets, the sort of the Teslas of this world, the NEOs, the renewable energies, also the sort of like the software as a service stocks and all those kind of things that are getting a bit of a battering. What are the sort of like the ideal trading conditions? Is it sort of like more complex for professional traders like you would give you more chance to generate alpha, or is it really just we want simple momentum and a one-way traffic, you know, sort of like one directional, and it makes it easy for everybody?
I think if you want an easy life, it's the latter.
Yeah, okay.
Let's be honest. You know, with the way things have taken a turn for us all personally in the last year, an easy life would be welcome right now professionally. But in terms of going back to, I think your instincts as a professional compared to how everybody has been making money, it seems, over the past year or two, just being long anything in equities. Dispersion with valuation ratios, it really does bring out or remind you of the core, a little bit like when macro wakes up again. That's a true traders as market, as professionals, and it becomes a far more interesting puzzle to fix, but it is certainly more challenging. So what would I like? I'd love to see a return to momentum, but I have repositioned and I'm more diversified now, having taken a pro-growth approach still to the beginning of the year. Paid off in February for the most part, but yeah, I've had to adapt.
Yeah, I mean, I'm guessing that basically a lot of sort of momentum traders, unfortunately, we're not going to see that environment going forward, because the yield is increasing for good reasons. The economy is reopening, and frankly, as long as we don't get a second pandemic with all the sort of stimulus, etc., you are going to see people getting back into jobs. You're going to start seeing the economy reopening, and on that basis, then the yields are going to carry on increasing, largely just to reflect inflation, essentially coming back into reality and making sure that we're going to have a sort of like in real terms have at the same level of real yields on bonds, etc. So I'm with you. It's going to be more complex going forward. Now, this 12 months ago, we're almost back to March 2020 when the markets got absolutely mullered, and my portfolio in particular. And it was a pretty stressful time for me as a small cap investor, long only, and sort of like, you know, just a sort of like a fairly concentrated portfolio. But what's it like for professional investors on a daily basis? How do you manage the sort of like the stress levels? Do you have a sort of like a boxing punch bag underneath the sort of the flat or something like that?
Believe it or not, there is something that during lockdown, boxing's become a new pastime. But I'm not sure that it's something that I can't fight back. I'm not sure that when I get hit in the face, like I do with the market each day, it's really going to be something that I continue doing.
Yeah.
But it's last year. I was for one of my major clients. I do outsourced investment management or OCIO services. My largest client, who has since sort of moved on for various reasons, not to do with performance, towards the end of last year, I was managing the long on the equity strategy and also a tactical asset allocation based fixed income strategy. So using ETFs there to trade basically a credit spectrum rather than individual bonds. We weathered that, and doing so for a retail asset manager, where it's individuals' pensions as opposed to, big, perhaps private.
That must be massively stressful. Somebody else's money.
It was, but I tell you what, we weathered that really well, and the call that we made in the asset allocation model turned negative in April, May time, or was negative in response, not surprisingly. But I had to take a discretionary call to override that. Now, when you talk about challenges of what are the truly risky calls that I remember, or the stressful times, it's when you have to sometimes recognize when to go against your model and utilize some of your discretion and trust your gut and your experience as an individual. So it's very systematic, as I think is important to remove a lot of the emotion 95% of the time. But had we have not, or had I have ultimately as CIO not taken the call for the fund, when we were staring at drawdowns as everybody else in the market was, everybody was caught on the hop, being long on the equity for the most part I'm talking about. We had to take that call, and it proved to be the right one, because otherwise, of course, we'd have been crystallizing losses at the drawdown. My thinking, or my thought process was, in its simplest form, that nobody had opportunity to react. Now, I understand or appreciate that on one side, it could be said that, well, everybody has yet to sell. But equally, I think the position we were in with stimulus anticipated, and of course it did materialize pretty much immediately. We were still in an environment where it was going to come back, or at least there's going to be huge stimulus, and you might be able to sell a bit higher if you were planning on getting out still. So that bought us a little bit of time. So I said, let's be patient with the asset allocation model, see if it's still negative in a month or two, if we see a tactical retracement or slight recovery on hope. And as it turned out, it was obviously sustainable, the recovery, and more than when it obviously tech and everything else went to new highs. So that was a stressful chapter or call, but the right one. And I think I learned a lot from that in terms of when it's important to sometimes deviate from your strategy, your process, when things just are different. You can't always be driven by models and data. You sometimes just have to think of the market in terms of investor psychology and mass participation behavior, and that proved to be right. So just to close this section in a minute before I move on, contrasting that, I mentioned that towards the end of 2020, I moved on from doing business with that client or on behalf of that client. My current sort of venture and foray, which is a new thing for me this year, has been to return to a retail trading environment and trade on a retail trading platform. No sort of affiliation with the channel or anything here, of course, with this interview happens to be with eToro, and I won't get into long and short of how I found out about this popular investor program, but essentially it's an opportunity to manage money, in my case, like a professional would do, but in a retail environment, and without the regulation or the nightmares of that. But it's been really interesting going to this sort of different style of trading and this trading platform, seeing what the general public are typically doing around you, all the generally mistakes or correlated trades that they're in. I'm by no means perfect. I make mistakes as well, but they're not as big and as costly as perhaps a retail investor might make when trading. So in comparison to the chapter doing institutional management for the main client last year, having done this, where it's in the public domain and anybody at any time can see your positions and your performance, keeping in mind it's members of the public rather than people who are, they've seen this before. There's always going to be
very transparent.
Yeah, and with that, 'cause it's a social trading platform, that aspect, I think, of constantly at any time, day or night, being accountable to anybody in the world who's looked at your performance and is maybe sending you a message scrutinizing it, or equally, everybody jumps in when you've had a good month, and inevitably we know what happens when you chase performance. Nothing goes up forever, including a manager's performance. Would like it to, but it's just not the way the world works.
Yeah.
It's one of those things. So, I mean, in terms of pressure, I'd say that now
More
doing
pressure now.
Yeah, I would.
Yeah,
So
I would agree.
hats off. What I've learned most recently, the last couple of months, hats off and a credit to the individuals, retail investors who have been doing this sort of thing on social trading platforms for a number of years before I've come along, and have actually managed to generate some pretty impressive assets under management, copy assets on that platform, and make an income for themselves as well. I mean, it takes a tough skin.
Yeah, just going to say, you need rhino hide, I guess.
Yeah, exactly.
And just in terms of sort of like, you hear the big statistics and, you know, sort of like spread betting and CDFs. I mean, they're not obviously, you know, taxed, because the majority of people lose money, and the government wouldn't want to put a tax on them and give everybody tax losses to claim back. So, I mean, how many people just broadly actually make money on the, you know, sort of like spread betting and trading on a daily basis?
I think the current number reported by that these companies have to report, I think it's on a quarterly basis, it's updated with FCA rates, is 67%.
Okay, so about a third make money.
Yeah, and it is. I have seen it a higher losing percentage, where it's like 80%. Even in some cases, it depends on the market environment. I think that in itself is quite telling, where fewer are losing at the moment because everything's been going up.
Yeah, I know. Yeah, the tax man's been losing out, hasn't he? But bad luck, Rishi Sunak. But I mean, what distinguishes between the successful traders and the ones who obviously lose, you know, the majority of the money? How do you actually sort of like move into that winning category?
I would say leverage first and foremost.
The losers use leverage, you mean?
yeah, it's been mapped out time and again. I think there's an old one back in 2015. I think it was like a client survey, it may have been FXCM or somebody like that, fx.com. It's one of these big websites, and they showed buckets or brackets of client profitability according to the degree of leverage used in their accounts. And not surprisingly, those who used more leverage were the ones who ultimately blew up their accounts beyond the critical point, but there was a positive correlation between the two. So I think the key thing is leverage. That's, you know, it doesn't take me to say that, it's been said many times before, but of course it's for the reason that it magnifies your mistakes, which you will inevitably make when you're a beginner, and you'll still be making some when you're a general retail investor and a professional. When you're a professional, still make them, but at least you have a process and you have more rigorous risk management then. Things are more robust and you can survive the mistakes even with some leverage if you are using that. But personally, in terms of how I teach at the academy and have been with Lex Van Dam since 2014, and how I've managed money professionally and how I'm doing so currently, it's without leverage. It's not that I haven't developed strategies which would utilize maybe long, short and cross asset stuff, but keeping things simple and in accordance with what I'm trying to promote on social media as well, for novice investors who have been locked down in this environment and in front of the computers with zero commission built into the spread, stock trading, for example, or share dealing. It's just really important. I think they get the basics right first before then developing, learning about themselves as well and their own psychology. As we mentioned, even years into your career, it gets easier, but it's still going to be very difficult and stressful at times. And you're always learning something new. There's always a new problem. Now, there we go.
Well, crikey. I mean, I totally agree. And I would really highlight to investors. I mean, one of the world's best investors, sort of like long-term, Warren Buffett, describes derivatives and leverage as the weapons of mass destruction. So unless you've actually got sort of asbestos suit or been able to handle that sort of like potential explosives, then be very, very careful with what you use. And I don't use leverage. And one of the reasons you get really stuck when you use sort of like margin, etc., or you borrow against particular stocks, even if you're long-term investing, you become a distressed seller. And inevitably, when the market goes against you, you're forced to sell. And hey, the vultures come out and pick up your corpse, unfortunately, from the road, because it's nice, easy pickings for them. And you saw that even with Neil Woodford sort of like 2 years ago.
Yeah.
So what? I mean, I was having a quick look at your portfolio on eToro, and you've done pretty well. You're sort of like 6.5% up in the sort of the first 4 months since doing that. If you annualize that, that's pretty good. That's 18% in the year. So that's not bad. I mean, what are you looking for, sort of like long term? I mean, presumably you're not going to knock the ball out of the park and generate sort of high double digits every year, I guess. I mean, that would be sort of like pretty much extraordinary, I guess.
Yeah, it would be great, but of course, we don't know what the market's going to give us the next year. So that again is something that dealing with the platform that I display my trades on.
I know.
You were saying, what are your targets? It's like, I don't know what the market's going to do in the next 12 months. I can anticipate it, but I'm not foolish enough to believe, and I know that's the.
But what would you hope to do over the long term as a professional trader? Would it be sort of like 2% above market returns if you're going long only, non-leveraged?
Something like that. I think net costs, which have obviously been reduced on zero commission platforms, we're not using leverage. Just to go back to your earlier point around avoiding leverage, it's also very expensive, particularly on retail investing platforms.
Yes.
On eToro specifically, this isn't to bash them. Again, I'm associated with them, but I'm not compensated or paid by them directly as yet, at least. Their CFD financing, the margin financing rate is 6.4% on longs above the reference rate.
Yeah.
So you're going to have to, with whatever bets you're making, you're going to have to expect to make at least 6.5%, probably 7% of the reference rate per year, just to break even on using leverage. That's another reason why I avoid it. So do I believe that I can guarantee I can absolutely make at least 7% per year in, year out? Compounding it, you would like to think so, maybe 10%, a couple of percent above whatever the S&P or index is going to do. I'd like to think low double digits.
Yeah. Well, good. Well, hey, that'd be a good strategy. My portfolio is still recovering from 12 months ago, so that'd be pretty good. Just on the sort of trading strategies you use, I mean, I did notice that you've got sort of like a 5-step approach of being able to sort of like find out or manage your trading. Can you just walk us through that?
Yeah, that's right. So this is Lex's methodology, which he and I have taught over the years, and it really began for him, I think, with the MillionDollarTraders TV series, the BBC show, which is still up on YouTube if people haven't seen it.
Is there going to be a second series? Because I did watch the first. No, I thought it was great.
Yeah, it's great to hear. It went down really well. We're hoping to do something new, but trying to find the right part to do it in the digital age. So to make it
well, hope to see you on it this time. Sort of like you teaching all the guys rather than I can't remember the other guy who was doing it, but it was Lex and somebody else, wasn't it, who were doing it?
That was it, Lex and Anton. Yeah. So we'll
Anton. That's it.
See where we're at in when we get there.
Okay.
So
the 5-step approach.
Yeah. So it's really just a framework. It's not rocket science, but it needs to be something that's actionable and you can actually follow.
A framework is important for anything.
Yeah. So it's something that you can always lean on when things get a bit more difficult, and it just becomes autonomous. You don't have to think about it.
Yeah.
In terms of intricacy, just day to day. So first step's idea generation. So Lex obviously talks about the process for generating ideas.
And how do you do that? I mean, is that just basically read the paper and sort of like monitor the markets, get up in the day and say, right, okay, this one looks good, let's do an investigation?
I think that's how a lot of people approach idea generation with the public. In terms of newspapers, I don't want to sound, again, all institutional high and mighty and I'm master of the universe. I don't read newspapers and all the rest. But I don't tend to. Of course, I scan Bloomberg and keep abreast of events really more than stock-specific news. It's generally the stock-specific stuff is earnings just confirming the positions that you're in rather than worrying too much about the future outlook. Focusing more on management steps, that gets more into fundamental analysis, the second step. Yeah. In terms of idea generation, you can begin with traditional sort of top-down view. So maybe now if you're thinking, okay, well, everything, and maybe you have picked up the paper, you just read the headline rather than trying to generate a stock idea from it, you've gone, okay, all the talk is about rising bond yields, all the talk is about moving out of growth or tech names and into so-called value or multiple names. So that can be a starting point to begin thinking, right, top down, value over growth, perhaps. Do we like developed or emerging markets? Maybe there's an emerging market slant to that, but just keeping things simple in terms of you thinking maybe UK companies or US companies. You begin filtering through and you think, okay, well, which sectors are likely to do better in terms of the value sectors or rate sensitive sectors, or perhaps financials or more cyclical industries, maybe industrials, maybe. You can work through that way. So you can use the macro as a starting point. You can still use the newspaper as a starting point, more in terms of the headlines and the events, macro stuff, rather than, GlaxoSmithKline has done this or done that, because by the time it's hit the paper, of course, it's already known. It's been anticipated probably.
So you're trying to find basically what the tailwinds are essentially going forward.
Definitely, yeah. So for example, cloud computing, again, that isn't a novel, but I think just also thinking sometimes as a consumer, particularly during lockdown or a recession, you can think, okay, well, how have my behaviors perhaps shifted or changed? Are the things that I have changed towards doing, am I likely to continue doing those even when we move out of the situation, or would I likely revert back?
Yeah.
You begin coming up with ideas that way. And I think in terms of something that's really actionable and more practical for beginners, thinking in those terms is a bit easier. I always use the example of, I used to survey after I read Peter Lynch's One Up on Wall Street, the classic, when I was still back in uni. I remember when I'd be back at term time, outside of term time, holiday time, and I'd be quizzing my mum and my sister and the ladies in the household to ask them, so like what cosmetics, what we've been buying recently and where we've been buying them from. And I'd be working through basically, is Estee Lauder a better investment than, I don't know, the next brand, Avon?
Yeah, L'Oreal or something.
L'Oreal, exactly, yeah.
Yeah, okay. All right, brilliant. So then moving on to sort of your fundamental analysis, what do you actually, does valuation come into the sort of equation at all? Do you ever sort of have a look at sort of like what you think an asset is worth compared to its price? Or is it really just looking at sort of like just the business, how solid the business is?
So the refreshing thing about doing what I'm doing now is that I can actually be honest.
Okay, yeah, no, please do. Absolutely.
Most people, this is the moment when the investment manager sits in a seat and goes, yeah, valuation is very important. We do all of this. All right, let's be honest. Look at those at least those who have made money, which is the majority of managers over the past few years. Valuations haven't mattered. In fact, the opposite.
Yeah, I know. Yeah. You hear that so often on the telly, is such that, frankly, nobody gives two hoots about valuation. However, that may change going forward because, value is coming more sort of like in fashion. Yeah.
So it isn't to denigrate valuation in terms of saying, no, I'll never bother with that. It's not important. It just hasn't been relevant recently or until recently.
Until it becomes relevant.
That's the thing. So it's about figuring out and anticipating those shifts, or recognizing when things have changed.
Yeah.
When the market, the themes or the dynamics are changing, which factors are driving the market. So that actually, to answer a little bit of the question before, that's where I spend the majority of my time focusing. It's more on factors for idea generation and also for investing in, if you like, baskets of stocks related to value or growth, and then within that, certain multiples or measures, ratios, quality, whatever.
Okay, so you do use some valuation essentially to sort of like, whether it's, you try and give an indication of what you think is something's worth compared to the actual price you're paying, and hopefully the gap will close at some point in time if some level of rationality returns to investors.
Yeah, but it has been until recently at least, and I think it's still the main.
It's been a dud trade for the last 10 years since the great financial crisis. Valuation.
It's determining which factors are currently driving the markets rather than specifically really bothering too much about.
Well, I noticed. You've basically picked up a few bank stocks, haven't you? You've got sort of like Bank of America. You've got JP Morgan, and I think you've got another one as well.
There's credit card, American Express.
And they'll obviously benefit from the steepening yield curve, but clearly, they haven't been exactly. The banks have been battered for 10 years, and they've only started to increase. And they're not trading at sort of like mega valuations. Even so, sort of like 1.3, 1.2 times book. So there is a valuation tilt there, I guess.
That's right. So I guess relating to specific positions that I have currently, there are going to be, I'm sure, I've basically got the most obvious financial or positions in financials that you'll find. But again, there's a reason for that. It's the path of least resistance. And within that factor or category that's driving the market currently or driving returns and outperformance, I'm looking for the best proxies for that rather than necessarily the most volatile ones with the greatest potential.
Yeah.
I'm just looking to get that factor exposure via those companies.
Yeah, okay, yeah.
Yeah, so JP Morgan, Bank of America, I mean, duh.
Yeah, no, exactly. Big money US centre banks, crikey, they should sort of like get that tailwind. Moving now to sort of the third one, I think was it technical analysis. You sort of like, how do you sort of like assess whether something's overbought or oversold, or sort of like everybody's on one side of the boat, like the guys who were short at sort of like into GameStop, and how do you sort of the technical analysis, or is that just all chart stuff?
I'll press you this by saying I started out, I think as many of us do, as a technician.
Okay, crikey.
Somewhat fond of technicals, but I'm certainly a lot more fond of everything else over and above.
Yeah, no, good man.
I'm still put in the box of the category of being a technician by some people now who knew me at the beginning, even now. And the fact of the matter is, it's the last thing I am. I'm pretty confident that in terms of strategy, I could not look at a chart, but there's obviously value to doing so incrementally. That's why I do.
Yeah.
Not look at a chart and I would still perform reasonably well and probably slightly outperform the market, depending on the conditions. However, that tactical element, when it comes to sizing your positions and scaling in and out of them, so taking profits ultimately, assuming that you want to be in all of those names, but which ones are you going to favour slightly more if you had a bit of a correction, and where are you getting out to look a little bit overbought, takes them off. Technical analysis is the only way to do it. So there are all sorts of wonderful, intricate ways that you can do so if you have access to information about flows, of course, institutionally.
Yeah.
That is a dream. I'd love to have that, but we don't all have access to that sort of thing. Looked at so many different ways in the past. Sentiment is key. There are just so many different ways of slicing and dicing this stuff. I found what works for me is, it's only something I started using probably 2016, so about 5 years ago now. I actually used Fibonacci retracements, which sounded like absolute voodoo to me when I began looking at them for the first time.
Well, I'm actually a mathematician, so I know Mr. Fibonacci. He's basically got certain set levels that are important in nature, isn't it, or something like that, and they're trying to be applied into financial markets.
That's right, yeah, the so-called golden ratio. So it's just a self-fulfilling prophecy where just time and time again, particularly for the fast money or speculators who are typically trading with leverage and moving the market around, hedge funds, therefore, more speculative rather than more passive, buy and hold traditional mutual fund investors or whatever. It's really useful for seeing where you might take profits. And yeah, I know it sounds like voodoo, but that's to my advantage. I found that it works. So I'm not as interested in, say, the RSI or other
fear and greed index and stuff like that.
Okay. Exactly.
So just with the Fibonacci, I mean, just looking at sort of price action, I mean, it does definitely sort of like give an indication of past sentiment, but does it actually back test in terms of going, because I mean, 90 or 60% of trading volumes nowadays are done by algos and computers, and frankly, they couldn't give two monkeys what Mr. Fibonacci's been saying. They just run according to what their program says, and therefore you've got this sort of like freight train overlaying most trading. Maybe it's not in specific stocks. Maybe it's in sort of the indices and other more treasuries or liquid assets. But you'd have thought the algos would just basically effectively, railroad over any sort of like, individual human biases and human behaviors.
I think that's a good point. To me, at least, day trading is futile unless you're in an investment bank and you're able to see the flows. It's just futile. Particularly then when you
That's pretty honest from a day trader.
Again, people call me day trader.
Yeah, true. Absolutely. No, absolutely. You've got to get a system which works, haven't you? Yeah.
So look, in terms of how I trade, just briefly, my horizon, I typically have an 80-20 or similar to core satellite split. So 80% of my book, long only, is going to be in core positions. So those are ones with 3-month plus horizon, of course, unless there's a massive shift in interest rates and you have to start abandoning being purely in growth and have to rebalance. Yeah, so 3 to 12 month horizon on 80% of my book, and then 20% I do trade more tactically in those names, and that would be therefore with a sub 1 month horizon. So yeah, that's how that's done.
And what would you sort of like look for if you put a sort of 3-month position on, I don't know, in Alphabet or something like that? What return would you hope to get then, as in like upside, downside? And would you use stop losses to manage your risk exposure?
Stop losses, no, absolutely not.
Good man. That is the right answer.
Absolutely not with stops, and particularly based on what you just said around all high frequency noise and activity, and then brokers doing what they'll do. Absolutely do not use stops. I think the single best piece of advice I could give to, for what it's worth, to any novice is, I mentioned leverage before. So if you give yourself time and space and sufficient diversification, there's no reason why you should be using stops once you have at least, you know, a basic understanding of what you need to be doing. You shouldn't be trading at all if you don't. So don't use stops, they'll work against you. If you're long only, you've got sufficient diversification, your risk is sized, or your positions are sized accordingly. You don't need to worry overly about any given position on a particular day, given the noise as well in the market.
Can I give you a bit of a warning? Tomorrow morning when this video goes out, you're going to get a lot of abuse, because I've repeatedly said I don't use stop losses and got battered by people saying you should be using them. So just to let you know, you'll get a tsunami of emails there, James.
To be fair, it's probably different if you are trading other assets. If you are trading currencies and commodities, but those are more speculative short-term. Well, they are speculative by nature. You don't really buy and hold sterling or whatever, a particular currency based on fundamentals. It's fast money. So
how do you measure your upside downside when you go into a position then? What do you look for? I mean,
the F word.
Sorry?
The F word.
What's that then? Fibonacci, okay. But I mean, you look for sort of 10% up, 15% up and 5% down, or is that sort of stuff? Or is it really just you're looking at more long term and you're just really confirming your view on a longer term stock that it's healthy and it's worth having?
Longer term, again, I'm looking for the best proxies or vehicles to gain the factor exposure, the exposure to the factor.
Gotcha.
Value. And then in terms of the tactical element, where I'll overweight a position, of course I don't underweight, it's a core holding, it's just what I want a bit more short term. That decision I'm making based on how much upside potential does it look to have from here. So yes, I am doing an element of that for a smaller part, and that is based on Fibonacci, on the extensions and the levels. Obviously, if it's already breaking out to a new high and it's overbought, then it's not as relevant, but sort of middle of the range and there's a good extension to work through the levels, as you can see, then I'll be targeting the 161.8 fib or whatever as an extension. And I know that's my hard target for then taking the overweight off, tactical component, and just going back to a core position, assuming that I still want the factor exposure through that company and others. Okay, and as a sort of like a trader, how do you overlay the sort of the Elon Musk and the Reddit sort of factor, all these sort of big influencers? I mean, I think you also had Chamath Palihapitiya, and you had sort of like you had Donald Trump last year, all just throwing stuff on a daily basis out into Twitter, and they really do move share prices. So, you know, how do you factor that sort of like almost like they're not black swans because everybody knows these guys are out, but you don't know when these nuclear missiles are going to hit. It's unpredictable. I think you just got to surrender to the fact, or at least I do, surrender to the fact that you can't stop it. It's going to happen. You don't know how the market's going to react. So the last thing you should be doing is overreacting. In other words, being reactive rather than just accepting that, okay, well, that's moved the market today, I'll probably come back tomorrow. It's just as fickle, easy come, easy go. These things sometimes do cause shifts, but it's just noise, and you just got to give yourself a bit more distance and just continue to have conviction in your positions. But again, if they're appropriately sized, sufficiently diversified, if the market goes down a bit because Trump's tweeted back in the day, then
and not leverage. That's the important bit. You don't want to be flipping, you know, as a distressed seller, I guess. Now, I did notice in the portfolio, you sort of like concentrate firstly on just single stocks rather than any other sort of like, you know, asset class, bonds or anything. How can we go for single stocks for sort of like, or indices or anything like that? Is that just because you feel as though the more fundamental side has got a better, you know, that factor and fit is closer to single companies?
Yeah, I think I think currencies and commodities, for example, and indices within that, particularly FX, they can be a lot of fun to trade if you're into technicals. And that's why I think a lot of that appeals to typical sort of more intermediate retail investors, so not the beginners who, you know, only do shares, but the ones who start maybe spread betting and so on and start losing money inevitably and all the rest for the most part. The reason I stay away from that is because there's no real edge there. And those products are generally traded on margin. So again, you've got leverage as a factor. You're not going to trade them unlevered really because it's not the volatility. And before you know it, you start using stop losses and things like that. And it's a way to the poorhouse. So the reason why I avoid that as well, and this is a main point about my relationship with what I'm doing on eToro is the only reason I'm showcasing my strategy there, because I was doing long on the equity previously for outsourced clients institutionally. The reason I'm doing it on there is because it's zero commission. There's no other costs in the spread. There's no stamp duty either, which is pretty good for UK.
Yeah.
I don't tend to do UK, but it's good for people on
And
there.
that's why you do the US, single stock US rather than single stock UK, because there's no stamp duty.
No, that's not a reason why I would do US over UK. If anything, it would draw me more to the UK as an advantage. But strategy-wise, I focus globally, but inevitably, like every other investment manager over the last few years, we've just been looking at the US. Maybe that'll change sometime. You know, there's constant debate. But the reason why I focus on single stocks and not other things is because then every other product on eToro's platform comes with big costs and of leverage and everything else.
Oh, okay, gotcha.
And that's the reason why they're able to compete. It's a little bit like a loss leader, although it's still probably not a loss leader for them. A bit like white sliced bread, the zero commission share deal.
Yeah, okay, gotcha.
And then before long, if you lack the discipline, you get tempted or whatever, which most people will, I think, you end up trading the more exotic products with the financing and they make a fortune off you, and you're probably losing money as well, which isn't good, but that's what happens.
So managing your costs, essentially, your commissions, is critical to your long-term returns, I guess. That's what you're saying as well, isn't it?
Absolutely. And you can be as patient as you like when there's no custody or other financing charges or anything like that.
Yeah.
All in. And as a beginner, and certainly as a novice retail investor, give yourself every possible advantage in terms of the economics as well, and afford yourself time. Buy yourself time. You can be more patient. You don't have to take losses and stop yourself out and all the rest.
Yeah. And when it comes to diversification, how many positions do you typically have when you sort of one time? You've probably got about, I don't know, 20 at the moment, or 15, 20?
About 21, 22 currently. So around 20 to 30, I would say, to the lower sort of end at the moment.
And that gives you good, sufficient diversification, or effectively into the factors that you choose you want based at this time.
It does. It does.
No, I would agree. Given the big caps, crikey, you've covered just about every single base there. That's for sure.
I don't want to end up becoming a total ETF or.
Yeah, no, absolutely. No, I'm with you. Yeah. And how do you measure yourself? What sort of KPIs should sort of like traders think about in measuring themselves? Is it just purely returns, or is it actually sort of like a bit clever and risk adjusted returns?
So I think the institutional answer you would get is always going to be the more intricate, trying to make yourself sound clever one. But right, there's a lot of money in the industry for those who do it well, so you should be held to account and great scrutiny. Yeah. The people will have probably heard, the public will probably heard of the likes of Sharpe ratios, for example. So that tries to determine your excess return or what you generated.
The alpha.
The market, the outperformance. But for me, the preferred measures might be the Sortino ratio, which is similar to the Sharpe ratio, but only considers as a denominator the downside deviation or downside risk, rather than worrying about upside volatility, because that's a good thing. You want upside volatility. So that's one. But for me, as a thinking in terms of my own money, and now a more sort of retail approach or private investors approach to the market, there's things like the ULSA index, or basically considering your drawdown, your maximum drawdowns, drops, compared to your average return, so your annualized return over the years, because that, I think, is the risk of impairment, permanent impairment, is a thing that I worry about most when it's my own money, because then it isn't a relative game. It doesn't matter that if the market was down 50% and you were down 48 and it never recovered, it doesn't really matter how I perform. But when I'm thinking of my pension and everything else, which is self-managed, then it's certainly the risk of permanent impairment. So that'll be an alternative measure. But most importantly, I think after drawdowns, just don't take it too seriously as an individual, and take the process seriously. But in terms of investing, try and have some fun with it. It's ultimately, for a lot of people, the reason you're not delegating it to somebody else is because you have an interest in it. You like reading the paper and understanding what's going on in the world. Enjoy it. And don't get too hyped up. If you're making 10, 12%, whatever it may be, then that's cool. You can
that's fabulous. Yeah, I agree.
But you can't eat relative performance, as he always said.
The danger is you get sucked into it so much on a daily basis, looking at the movements of particular share prices and assets, that it becomes not only addictive, but you get sort of burnt out mentally, because you're just sort of worrying all the time. And as we all know, the sort of like the loss aversion is much greater than any gains you ever get, and therefore you concentrate on the mistakes you've made rather than some of these successes, and don't put it into total picture.
Absolutely, yeah. Don't they say that, isn't it? Supposedly, I think it's a very crude approximation.
Yeah.
Twice as intense, this emotion behind loss as opposed to the emotion behind joy. As good as joy or winning feels, it's a lot more painful. I
heard the Wall Street Journal one time saying it was 4 times more, which depends on individual, but it's certainly...
bond yields feel about 4 times as much at the moment.
I know, yeah. How do you decide when to sell a position, by the way? Is it like, is that because your thesis breaks? Is it because it becomes, sort of overvalued compared to the price moves significantly higher than your target or your valuation? What's the sort of trigger when it comes to sort of selling? Would you still go through that same 5 process? If the technicals are right, even regardless of valuation, you'll carry on holding it?
You'd repeat the steps, say, every 3 months.
Yeah, okay.
Let's say for your portfolio, review it quarterly, as you might do as a professional. But again, I think you made some really good points there, which I think are probably going to find, if we were to ask them again in a year or two, probably get quite different answers to a year or two ago. Perhaps valuations haven't mattered so much until recently, but going forward, it's all about the bond yield. It's going to matter increasingly more so. It's going to be more of a stock pickers environment, it seems.
Yeah, okay.
In a one-way bet.
Yeah, and what sort of like, just out of the portfolio, what sort of just highlight to investors a couple of things you're sort of like, you're running and you're pretty interested in? I mean, I see you've got your biggest holding is it Chartered Communications. You've then got Amazon, American Express, Bank of America, Estee Lauder you mentioned, and TransDigm, I think, bought Cobbin's aerospace business recently, actually, completed it. So that's a sort of like an aerospace components, which I'm not surprised is doing well. What are you sort of like your interesting stocks for sort of like for investors?
So the way I'm thinking about it at the moment at portfolio level, again, the internal battle that we face every day when the yield's gone up a bit more or something's changing. I'm thinking recently about, okay, if yields continue to rise, how comfortable would I be, or basically which names would I still be comfortable owning long term? So accepting that short term there's going to be probably downside risk. But long term, which companies on there, hand on heart, would I still want to own, irrespective of what's going on in macro land? And I can say, having gone down and reviewed, for example, just quickly before this, before our call, having gone down and just did a run through of where free cash flow yields are for these companies.
You sound like a value investor.
Well, just thinking in terms of what I thought was pragmatically, not too worried about.
No, I'm impressed.
But let's think relative value compared to where the 10-year bond yield is. And maybe you'd look at 5s or 30. You could look at any 10-year, but let's just say
10-year. I agree.
The 10s. So if the 10s are currently at 1.6, and when I've done some my groovy, fundamentally I feel as though they could reverse a little bit. It's an extreme
in the short term,
extreme positioning. I think there was record short positioning in terms of flows and spec positioning revealed or disclosed last week. Something like 45 billion in new shorts, right? Bloomberg said. So it's a record short exchange. I think it was in the 5s. So let's say that the 10 years at 1.6 now. The reason you said about long duration stocks earlier on, Microsoft is sort of bucketed within that.
10 times sales, Microsoft.
Yeah.
It's a tremendous company, though. Absolutely tremendous business.
Yeah, I still love the cloud growth. No,
I agree. Money, license to print money, basically.
Yeah. To bring it back to the yield, when I think in terms of relative valuation, not within that portfolio and alternatives, different stocks, but I'm thinking which businesses would I not own if the bond yield is at 1.6%? Facebook, Google, Microsoft have got free cash flow yields of 3%, give or take. Right? So unless the 10-year gets to 3%, which is not going to, I don't think. I think I could see 2. I could see 2.35, 2.35 in terms of the projection if it breaks. I don't think we'll see above 2.5%. So I'd always rather own Facebook and these great companies than a bond. Certainly long term, maybe that's more my age as well. But Google, Microsoft, particularly at 3% free cash flow yield, companies growing at 15, give or take, 15, 20% per year. Okay, even if that is revised down to conditions which can't see happening for tech, regardless of what happens in the world, inflation pressures and all the rest, cost pass through, whatever, input cost inflation, which isn't really applicable for them. There's all this stuff. Amazon's a little bit different because that's only yielding, it's just under 2%. So that's around the same level, 1.7 as the 10-year now. So you might think about things slightly differently there. So that's a bit more sensitive, but its revenue growth in like the pandemic was 40% last year, there or thereabouts. So if we're fearing, as much as it's been supposedly predicated, as the Fed said last week, where they failed to really reassure investors, but they said, equity guys should like the fact that it's in fact indicative of an improving economic reality. Yeah. It's not just fears about inflation. You can discuss that, but if we were to go back into a recession onset by steepening of the yield curve, then I don't think Amazon's going to have negative sales growth at any point. So we can go through the valuations, but basically I see between 2 and 3% for the majority of these positions. If I don't expect the 10-year bond yield, even if it does continue higher, I'm not trying to predict the market, which I know is fully the bond market. Yeah. I'm watching it as an indicator. Now, most important chart in the world, if that got above 2% and it got up to 235, then that's really the only point that start to put a squeeze on things, thinking in terms of ownership of businesses long term, forgetting what the price on the screen is. So you still have all of that growth in cash flow and in revenue for tech companies in particular, regardless of the economic environment. And particularly if this choked off the economy and did send us, the downward way into recession for whatever reason, then those companies will continue to grow. And the last place I'd want to be is in financials or heavy industries, heavy cyclicals. Yeah,
we've all got to hope that the economic recovery does actually happen. We don't get another pandemic. I would add with the tech stuff. I mean, certainly a lot of the FANG stocks are not expensive on a sort of like on a PEG ratio, because their growth is more than sort of compensated for actually relatively modest PE ratios. Yeah. The only issue you slightly get is that because their comparatives from last year have been effectively jump-started because of the pandemic. Everybody was in lockdown. People were ordering shed loads of books and streaming and new computers and needing new software and all that kind of stuff. That's probably been a slight one-off event last year that might be difficult to repeat this year. So you might get a slight hiccup this year, but I'm with you. They're gigantic tech businesses that frankly should be around for 50 years, never mind 5 months.
Facebook's a good example of that, Paul, where they, despite having a pretty good period, they did warn of headwinds going forward in the core ad business. But in comparison, Google was the opposite. So for me, Google and Microsoft today has of course had a hack announced by Chinese.
Yeah, exactly. Yeah.
So looking forward to 2:30 when that opens down probably about 4%. It's going to be a fun week when I read that. But hand on heart, if that didn't happen, it's like I knew going into this week I would never sell Google and Microsoft. I just knew that if I had to just sell everything and go 100% invest, I had to be fully invested. Those companies I'd hold through anything, whatever's happening with the yields, because of where they are right now.
Yeah. Well, I would say you've got a nice sort of blend anyway of value and reopening, and also with the tech stuff, because you've got Stryker in there as well on the healthcare with elective procedures. And you seem to have the banks, which obviously should do well if the economy gets going. So if you have if there's a slight bring down on the tech side, you'll make the money up elsewhere.
That's the thing, a bit of a barbell. The one thing I'm looking at, Paul, sorry to just pull it back.
Yeah, no, please do.
What I'm looking at right now, we talked about what's in the portfolio, but what isn't in the portfolio, I really am looking at with great interest as of certainly the end of last week.
Spill the beans then, James. What are you looking at?
Maybe, and I'm not making a broad, as in across the portfolio, a broad return to momentum exposure, but some certain stocks, and I still think they've got further to go, many of them, to the downside potentially, so that I'm not touching them yet. But there's one name in particular which does appear to be different, and that's Costco. You probably heard it picked up on in the press, but generally focused on US, in that's global strategy.
Yeah.
Costco, to me, has erased all. First of all, we can go through evaluation, yada, 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 but just going technically as well, after having done all of that behind the scenes, it's erased all of the post-COVID or the COVID period gains back at the beginning of 2020 or March 2020. Free cash flow yields, I think I've noted it down here, is 4.5%. seems pretty good to me. Massively oversold if you do look at the RSIs and things like that.
Yeah. No, interesting.
Back to the previous breakout level, God knows, probably 20-30% off the high. Still grew by 12.5% revenues last year. Okay, those are going to be boosted. The 5-year average is around 7-8%. Even if it reverted to that, because we're not in a recession, I'm fine with that. But you'll still probably get an 8% or expected an 8% sort of compound return over the next few years holding it, which of course I don't expect to hold something as long as that. But looking at extremes, and what's really hated now, where the pain has been, is one company which really stands out to me. And if I was to take a position in that tactical part of my portfolio, a really big one right now, to try and pick up some performance this month, make a bold bet, I've got to spend more time on it again today and early part of this week, but for me, it's Costco. I'm looking at it very, very closely, but I wouldn't be indulging in the other momentum trades right now. I think it's too soon, and I don't think it's right to be in there. I regard the likes of Google and Microsoft to be more growth and quality than just momentum, like the shitcos and the others like C, which I've held in the past, and whoever else, ServiceNow, and all these, Shopify.
Yeah.
For example, all of these companies, that's a bit different. Have cool things going for them, but that's a bit different.
No, I would agree. That sounds like a very sensible sort of like have to look over, because I agree with you. There are a number of large cap American stocks that have basically been left for dead, or should we say they've come off a lot recently, largely back just really on that rotation trade. They've been sold off unfairly, and I'll definitely say I'll have a look at Costco as well. So I think other people should have a quick sort of like run the slide rule over it anyway. Just before we sort of close, what would be sort of your last bit of advice for sort of like budding Bobby Axelrods of Billions then, to sort of like on the trading side? What would be sort of like, your last nugget of sort of good, sort of advice to give them?
Take your time to learn, enjoy it, try and enjoy it, because at certain points it's going to be very
painful.
Yeah, very painful at certain times. It's a constant challenge with yourself as well as the market a lot of the time, in your head. A lot of it's based in psychology. So, your heart's got to be in it. And if you're doing it for yourself as an individual, personally, just enjoy it. Don't forget that it's meant to be fun. If it's too much, or you're feeling as though you've got to take risks, more risks than you would like to do to try and generate returns or catch up with what other people are doing, just consider something like a low-cost index product, a typical ETF. It's dirt cheap now. Yeah. I wouldn't otherwise, promote those for any other reason, but it can be simple. If it's stressful, just convert it into an ETF, have a month or two off. When you feel like coming back to it and stop picking, maybe work's got busy or whatever, you can come back to it and pick up with it. It's no bad thing. But yeah, just, don't commit the deadly sin of over leveraging yourself at the beginning, trading on margin, and magnifying your mistakes. Give yourself time, enjoy it, and just don't take it too seriously. The process is very serious, so at least try and enjoy the the actual outcome rather than just it turning into your captor. Yeah.
Well, brilliant. Well, thanks very much for your time there, James. Fantastic and very honest insight. So thanks very much for that. Where best would it be if anybody wanted to sort of like learn a bit more about the sort of the trading with really a flavour of value associated with it? Where would be the best place to contact you? Is it on your own personal website, on LinkedIn, or wherever?
So there's the website MillionDollarTraders.com.
Yeah.
Basically, Lex Van Dam Trading Academy, where Lex and I have worked since 2014 together. That's the education side of things. And then in terms of my own personal trading, which we've been talking about, stock portfolio that I'm showcasing, you can find that on eToro as well. I have a personal website dedicated to that, trades with an S, tradeswithjames.com. Yeah. So I'm not telling you to trade with me, of course. I'd never make that endorsement, but tradeswithjames.com, where you'll find links to my eToro account with the same handle at tradeswithjames.
Brilliant. Well, I look forward to having a chat again in about sort of 6 months' time, when hopefully the portphio will carry on moving forward. So thanks, James.
No doubt we'll be back to the momentum trade by then, and valuation won't matter.
Thanks, Phil.
All right. Cheers, Paul.
Bye.